Hey everyone, Ben Nelson here with another episode of the Everyday Real Estate Investor. Thanks for tuning in. I am excited because I have a repeat guest here with me today, Zach Lemaster of Rent to Retirement. We're going to chat a little bit about what he offers to investors and talk about the market in general. Zach, thanks for being back on the show again. I appreciate it.
Ben, it's a pleasure. Yeah, excited to talk about. A lot has changed in the market since we spoke last, so it'll be good to kind of touch base on an update.
Absolutely. Yeah. Looking forward to it. So, for those that have not heard of you or heard you on the last podcast that I had you on, give a quick intro to yourself as far as like your business and what Rent to Retirement does for investors.
Absolutely. So we are a turnkey provider, and pretty much at this point, the nation's leading turnkey provider. And so what we do, Ben, is we assist people in obtaining or reaching their financial goals, financial independence through real estate investing. Specifically speaking, in a turnkey setting where we do all the heavy lifting for them, where they buy properties that are either newly built or fully renovated, leased, and managed by our teams in markets that we've identified to be successful investment markets. So investors can come in and be a passive investor, learn to invest out of state, and scale and diversify their portfolio into an already built out system that we've established over many years. So to set themselves up for success, expedited success. So essentially, that's what a turnkey operator does. We work in multiple markets, mainly Midwest and Southeast, mainly in single family to small multifamily houses, where again the investor can come in and build their portfolio. We help them set up the business model and acquire properties that are leased and managed to produce cash flow immediately for them.
Awesome. Okay, so lots to unpack there. So, um, providing that ability for a lot of people are, I think, a little hesitant to buy. You buy a stock and it's like, what's the big deal? You don't ever see the company, but for some reason with real estate, if it's you can't drive to it, people sometimes are hesitant. So you kind of remove some of those barriers for that by having that turnkey ability. You don't have to worry about the management; it's in place, property's in good shape, it's either new or remodeled, and you're picking, you're involved in markets that are good investment markets. So you're kind of setting them up for success in not having to invest in their own market by removing some of those barriers. And I wanted to ask also on that investment, successful investment markets comment. I think that's a good segue into what determines whether a market is a successful investment market. What do you guys look at? I didn't tell you I was going to go there, but I'm going there. So
No, I'm glad you are because that's super relevant and it's always changing, right? I think that the markets are always dynamic, although there's certain fundamentals that we always want to adhere to. I would say that, and I'll say this too, just because I'm going to talk about the markets that we like for certain reasons and explain those. I mean, those aren't by any means the only markets to invest in. I think you can be successful in any market with the right strategy in place. But what we look for, Ben, in our markets, we like to be in areas that we know are just predictable to build a long-term portfolio. So these are going to be areas that have landlord-friendly legislation, low taxes, future population and economic growth, areas that have a diversity of industries, not just like, sectoral industry of, say, oil or gas or something like that, like,
Mhm.
diversity of industries, areas where we have affordable housing. We like to be in areas where it's below the median house price point for the average type of single family, which right now I think is like 430 or 437 last time I looked. So we're usually in like $200,000 to $300,000 single family or small multi, in areas where you have high rent to price ratios and low cost of living. So these are areas where you can actually cash flow well because the rent relative to the price point is higher, and we know that we'll have positive cash flow on the properties. Also, areas where the median household income is above the national average, lower unemployment. So these are a lot of just some of the metric points that we look at in determining areas where we know that we're going to set ourselves up for success long term, and where the numbers make sense.
That's great. So anybody listening to this, go back and listen to the last 2 minutes about 10 times, and then you'll know what things to be looking for good investment markets. And to your point, it depends on your strategy a little bit, right? So sometimes you're a cash flow portfolio building type model. is what you are. And, sometimes people are more equity based. And so those are going to be different markets, right? Different strategies for equity growth versus, now, not saying that the markets you're in don't have equity growth, but they're different strategies, different markets a lot of times, right? So, yeah,
Definitely.
appreciate that. That's a great like little 2 minute. Here's what to look for in a good market. So I appreciate that. Um, so with that said, how you look for them? Do you mind sharing kind of what markets you guys have been involved in, and maybe some markets that you are seeing maybe some new opportunity in?
Certainly. So, yeah, over the past year, we've really made the transition to focus more on the build to rent space, where we're like specifically talking about new construction. We like new construction because these are areas where you have low maintenance. You actually have literally have zero maintenance the first year, and then you have builder warranties for many years on like things like mechanicals, 10-year on foundation. You usually attract better quality tenants. You have better appreciation both in rents and market value year after year. So that's an area that we've certainly focused on more aggressively because of the opportunity there. And so new construction and the build to rent properties are mainly going to be in the Southeast. These are areas of the Sun Belt where you have population growth. So these actually would be areas that have pretty strong appreciation. And that also means, to your point, Ben, maybe they're a little bit higher price points, so a little bit higher barrier of entry. You need more money down to buy those. Average price point is, I think, low 300,000s for the single family new construction that is renting out at $2,700 or $2,800 a month in rent. So great cash flow, but
Mm-hmm.
also strong appreciation year after year because of supply and demand, especially in areas like Florida where construction's slow and you just have. I mean, Florida had a 2% population growth last year, which is higher than any other state. I even beat out Texas for this past year. So,
That's
I mean,
that's a lot considering how many people already live there, by the way. So
Exactly, and
yeah.
and that's concentrated in certain areas. I mean, Florida is great from a business perspective because is very business friendly. There's no state income tax. That makes sense for people to live there, but also businesses to operate there. From a landlord perspective, it's very favorable. Florida is the state. Adam on our team just ran these stats for me the other day that it, Florida is number 2 for the quickest eviction state, and it's the
Interesting.
slowest for foreclosure. It's number 1 for forced
Very
foreclosure.
interesting.
So what
Okay.
that means is it's a safe place. But anyway, that's just one example of area where there's an oversupply and an undersupply and an over demand. Where it's a great place to be in residential real estate where there's huge housing needs for resale as rental as well as residential buyers. So very active in Florida throughout the whole state. Certainly concentrated in Southwest mostly. But we have some areas in the Panhandle as well, and in different areas, central located areas as well. Alabama, this would be mainly between Huntsville and Birmingham, areas that we're very active in building. We have some areas in Texas that we do build to rent, and this is duplexes and single family. San Antonio, also areas outside of DFW in kind of secondary markets. We work in South Carolina, as well. And then we also have the TIPO that's built to rent, and then we have the traditional turnkey stuff that's an older house and a bread and butter rental that's lower price point, so maybe $150,000, where you can buy a house with $30,000 down, have just produce a 12% cash on cash return or whatever, and just have a good cash flowing rental property in a stable market, mainly in the Midwest, where Ohio, Missouri, and Indiana, and we have a small team in Michigan as well.
Awesome. Thanks for sharing that. Yeah, I think when people are looking at this as an opportunity, I think especially if you're a newer investor, you haven't made your mistakes yet. It's really easy to get uh, to look at a pro forma and let the pro forma say, "Hey, this is a better investment," because it's really easy to make numbers say what you want them to say, right? And with new construction or even your turnkey remodels, you're taking a big chunk of that, that those questions of maintenance and I mean that's your one of your biggest, maintenance and turnover are your two biggest costs. And so you're taking the maintenance piece away. So maybe you're a little bit lower number on paper, but you're not going to have to worry about unexpected repairs, things like that. And you're probably going to have, I mean, you can answer this probably, probably less turnover in the type of properties that you're providing versus some of those other ones.
Yeah, I mean, new construction demands better quality tenants that tend to stay longer because it's new. Just like if we were buying a house or renting a house, we like new, right? People just like to live in new. Rents are higher, as well.
Mm-hmm.
So like the $150,000 house in the Midwest, that's probably renting out at $1,300 or $1,400 a month, whereas it's, quite more expensive than that for a $2,700 or $2,800 a month rent in new construction, whereas that's going to demand a better quality tenant. And people do tend to stay longer as well. So that's certainly the case. I think better quality tenants with longer term occupancy, less turnover, and yeah, you have less variability. To your point, I mean, we offer on new construction specifically in most areas 1 year rental guarantee. Where like you have zero vacancy because we're paying your rent if there's not a tenant in there, even though. And we can do that because we know it takes 14 days to lease out a property because of demand,
Yep.
and we can
Yep.
confidently offer that. But yeah, you have no maintenance and things like that. But I think, yeah, I mean, just determining what's right for you, and on when you come in, I want to touch on the point that you mentioned about the pro forma, because yeah, a lot of people look at like, oh, my cash on cash ROI, and like they clearly, if there's a 15% cash on cash, then that's better than a 12% ROI property. But I always tell people that a pro forma that's a year one snapshot, right, of
Mm-hmm.
of potential performance. And actually, in real estate investing, at least my opinion is that cash flow is the most speculative portion of investing in real estate. You don't build wealth in real estate through cash flow, although people like to look at cash flow because it's the most tangible, immediate access of owning rental real estate. And it's like, okay, well, if I cash flow 10 properties, $1,000 a month, I can retire from my job, or blah, blah, blah. Like how you build in real estate, build wealth is through all the other things, right? It's appreciation, it's using leverage and letting the tenant buy that home for you over time and paying that loan down, using maximizing your tax benefits and depreciation
Mm-hmm.
on the house. Like, it's all those other things that are important. But sometimes from a newer investor, yeah, you may not know how to calculate those or how those even work. So part of it is an education process we walk people through to, yes, make sure that the cash flow makes sense based on your goals, but what are these other things that play in? How do they play into your goals and timeline and resources, et cetera?
Yep. Yep. That makes sense. So talking about cash flow, and we mentioned the market earlier on. Things have changed a little bit since the last time we had you on, as far as uh, especially in the finance world. We were looking at 3%, 3.5% interest rates last time we had you on. Now we're 7 or 8 for investor loans on a lot of them. So how talk about that? I know you have some lender options too, so you can get into that a little bit, just because they're a little bit unique in what they're able to do for people. But also maybe touch on if you've seen that affect the investors that are looking at your deals, how they're underwriting their deals, anything like that, and if it's changed your approach at all to your business model. It doesn't sound like it, but it's changed anything with that. But I'd be curious if it's you've had to pivot at all with those changes.
Yeah, I mean, the fundamentals of real estate don't change, right? Markets change, interest rate changes, but the fundamentals don't change. And we try to be in areas where the fundamentals always make sense and apply. But I want to set the stage before I answer this question about like how what we're specifically doing. But just for perspective purposes, for anyone listening, understand that we just came out of a scenario where we had the lowest interest rates we've ever seen in history. And then, much of the money was pumped into the economy, COVID, everything, like, and then on top of that, at the end of that, like 2 year, 2.5 year cycle we've now experienced the most dramatic increase in interest rates in the shortest period of time we've ever seen in history. So the
Absolutely. Yep.
steepest hike. And so
Yeah.
that causes a lot of concern with people and frustration. And they're like, a lot of people would automatically think, oh, higher interest rates, lower prices. It doesn't necessarily work that way. And what we're talking about, it's very geographically dependent. Some areas we've seen, and what asset class are you in, right? COVID demolished office space. You know what I mean? And there's certain
Hmm.
sectors in
Yep.
different areas of the country where we're seeing a decrease in price points because they were so hyperinflated with price points, multi-million dollar houses that, tripled in prices over the past 3 years. Those have to adjust. But if you're in where we like to focus, Ben, is below the median house price point, as I mentioned in the beginning about choosing a market. So most single family, we're below that $400,000 threshold. Those have not changed at all. In fact, we're still seeing appreciation, maybe not as aggressively as over the past few years, but it all comes down to supply and demand. So if there's more people moving to an area, they need to both buy more houses and rent more houses. and construction is slow. So we're still dealing with supply chain issues that are post COVID. So,
Yeah, and
um,
we're behind, 5 million. And again, you have to look at the local level, but we're behind what 5 million housing units or something like that. COVID didn't help that either, where it made it even worse, right? And
so
to your
supply
point, it's
and
not like you can just pump those out and they're on the market and your inventory problem solved. It's years and years and probably over a decade to even catch up on that at this
So,
point.
and right. And so if you just follow the population trends with that, like where are people moving, you're going to be safe. And these are areas where you're still seeing rental increases. You're still seeing market increases over, year after year. And there's still a lot of investment opportunity to be made, regardless of what interest rates are at. Also, a lot of people like in Florida, in Southwest Florida, we're still less than 2 months of inventory. And where an average inventory would be 6 months,
Hmm.
and I forget the exact calculation. You take like the number of houses available on the current market and divide that by the past month of sold inventory or
Yep.
something
Yep.
like that.
Hmm.
But anyways, the point is like 6 month would be an average inventory, and we're less than 2 months. And that's, you think about this too. Construction slow. You have all these people that have like locked interest rates at 3% or below that they're not selling because it's not like, why would they? And then you have all these people move into the area. So if I think if you're
Yeah.
in, yes, from an investor standpoint, some people have got like, oh, I'm concerned about the interest rates, but I always try to put things in perspective for them. Like, look, if you're underwriting a property right now, I call it 7% interest rate or whatever, which in grand scheme of things really actually isn't that bad. But I understand coming from 3% it is. But one of two things is going to happen in the future, right? If you're underwriting a property right now and it cash flows right now, either one, interest rates are going to go up, and then you're glad you locked your 30-year rate now because it's lower than it is now, and your property's cash flowing, or interest rates are going to go down, and prices are probably going to continue to go up in either scenario, more than likely, but especially if the interest rates drop, and then you can refi, and then all of a sudden your cash flow is even better, right? So as long as you're underwriting now, like interest rates are just a variability in time. And that was a very long answer, Ben, to say that we're still very active buying. We're still seeing a lot of investors active. It's just being intentional about what you're buying and location specific.
Absolutely. No, I think, and there was a lot in there. I think you hit one key thing that I wanted to touch on was, I always say, you look at the real estate, the news, right? And they talk about the real estate market. And I always say there's no such thing, right? Not on a national level. You can't tell what's happening in a market by looking at national real estate trends. It has nothing like it's not that you should ignore it. It's just that it's just the first layer of the onion, right? You got to peel those layers back and look at the local market. And to your point, it's not just, state, or it's not even just city, it's asset class, it's price point, it's neighborhood, it's all of those things. And so you have to find those opportunities. There's always opportunities where there's growth and there's things happening. And if you're too macro level, you're going to miss those opportunities because macro level, maybe it doesn't look great, but there's always those micro opportunities where things are happening and grow. I mean, even back in the financial crisis, there were markets that I don't know that there were markets that did well, but there were certainly markets that did a lot worse than others, right? There were markets that dropped 50, 60%, and there were other markets that didn't drop much at all, right? In
We
comparison.
owned a lot of properties through 2008 in the Midwest, and guess what? Rents went up. They kind of stagnated in price points, but now those houses are worth double what they were then, or if not more, right?
Yep,
So
there you go. There, exactly. Yeah, firsthand experience right there, right? So, but nationally, it was like the sky was falling, right? But there were still markets that were doing pretty darn well. So, um, are you seeing? So, still seeing lots of opportunity is what you're saying. There's not. You got to make some adjustments probably in your expectations of cash flow right now. If you were looking at interest rates from a year ago, but there's still opportunity for sure.
yeah, I think so. And look, this is necessary that we're having some, like the Fed is raising interest rates on purpose, intentionally, and they're probably way behind the curve of what they. We'll get on. We won't go too far deep into that discussion, but I mean, this is a good thing, right? Because if you look at the past like 3 or 4 years, I mean, it's just been such a crazy seller's market. There was so many people where you had to come in with, your best and final offer above asking price, all cash, waive contingencies. It's just like now there's better buying opportunity, which
Absolutely.
which is a good thing. And it's still
Absolutely. Yeah.
competitive, but
Yeah, I agree, and I actually think it's a healthier market that we're in right now too. We're still low on inventory. That's one of the things that's it's actually continuing to drive some prices in certain markets. But it was not a healthy market last spring or the year before that. Bidding wars like crazy and inventory less than 1 month of inventory, and people waiving all these contingents. That's not a healthy market. We don't want markets like that. We want markets where there's at least some. There's always a buyer, seller. Is it whose favor is it in? But you want at least a little bit more equilibrium in the market than that. And so I think we're finding that with which is I think what they were after to some degree, right? With the interest rates trying to cool that housing market that was a little bit out of control.
it's a good thing, and there's buying opportunities. So we're certainly active, and yes, is a property slightly less cash flow if it's got 7% interest rate versus a 4%? Like, yes, but does that really matter? Not really. Rents will go up year after year. Is it still, are we? That's not why we're buying real estate. Is just for that little bit more cash flow, right? Big picture acquiring, like buying deals. To my previous point, like buying deals appropriately will build you more equity than cash flow will ever amount to in the long run. Not even buying a like way under market deal, just like letting time do what it does.
Yeah,
So, I mean, that's the biggest thing is time, not time. That's time in market, not timing the market. So,
it's exact, absolutely. Yeah, time in, not timing. Yep, big key point. Yeah, and I think that's one of those things. I think both from a market prediction standpoint and from an investment philosophy standpoint, I think sometimes people get short sighted and they just look at one metric, right? Oh, my cash flow is going to be less, and so now it doesn't make sense for me to invest. Well, to your point, there's a whole lot of other reasons other than just cash flow to buy, and so if you're only stuck on the interest rate or the cash flow, you could be totally missing your investment opportunity. And I think this people do the same thing when they are trying to look at the future of the market. They point to one thing like interest rates, or like prices have never been this high before, they have to go down. And it's like, okay, well, you have something to back that up, or are you just like using one piece of data? Because data lies. Especially, I always point to that you look at year over year numbers and stuff, I think are the biggest liar right now, because it's like, oh, year over year numbers, we're down on this, we're down on sales volume, we're down on that. Well, yeah, because they were ridiculously high last year, so that number means nothing. You have to look at historical trends, right? So I think in both of those instances, you got to look past just like one piece of data, one piece of information, and look at the story behind it. Look at the other things that could be affecting the market, the other things that are going to affect your investment, and not just make a decision based on one thing, right?
and I also think it's like don't overcomplicate it, right? Like this isn't rocket science here. I mean, investing, if again the fundamentals, are you in a good area? Do you have a good chance at cash flowing on a property, based on all the variables, interest rate being one of them? If so, why are you not buying real estate? What else are you doing with your money then?
Yeah,
If you're not doing anything else with it, well then you're not making any progress. In fact, the argument is that inflation alone, and lack of opportunity or lost opportunity is eating your capital alive. So you got to take action. I mean, but don't overthink it. I mean, think about the fundamentals. Real estate is a proven path to wealth. It doesn't happen overnight. But if you're just investing in good areas with good teams, and then the numbers make sense, that's all you really need to know, right? And
yeah,
then you just do that and continue to do that over time. And you wake up one day and you got a large portfolio that you've grown your net worth beyond what you thought fathomable in the beginning, and you have a legacy to leave your kiddos.
yeah,
So
absolutely. I can't remember who said it. I should know, but it's don't wait and buy real estate. Buy real estate and wait. Right. That's the basic premise of it. Is
yeah.
you know the longer you wait, the less you're gonna get the benefit of it. So Who is it? The real estate guys. They say what they say. You can't make money on real estate you don't own. I like that one too.
There you go. Yeah, best time to invest in real estate is 20 years ago. The next best time is
There's
today,
another one.
right?
Yep,
So
absolutely,
we keep
absolutely love
going, but the
it.
point is yeah. So it's like do something, right? Like time
Yeah,
is your biggest
exactly. Yeah,
advocate
stop
or
thinking about it.
adversary.
Yep,
So
I like that. That's great. Yeah. Oh yeah, I think we touched a little. Do you see? What do you? I mean, we talked about the market. I think in general, we're kind of hey, we're optimistic. Inventory is still low. Yeah, interest rates are higher, but there's opportunity, and I think that's what I heard from you. But again, you be careful of what sector you're in, right? Always be cognizant of what's going on in each sector of the market.
yeah, I mean, we work within an interview and within my professional network, there's a lot of really high net worth people, that are doing some cool things in real estate. And every single one of those, like, none of those people are having conversations like, oh, I'm concerned about this. Like in fact, they never have that mindset. It's,
Mm-hmm.
oh, I'm doing this. Look at what I'm doing. Or, hey, I'm doing this new strategy. Or I'm just doing the same of what I've always done, right?
Yeah.
Like, but it's sometimes the newer investors it's okay. Like I'm not trying to shame anyone here that's like concerned or nervous or gets the analysis paralysis because we're all guilty of that from time to time. But I will say that like if there's anyone not taking action, then it's the people that are they're letting fear or nerves or just you don't have and I forget what the saying is with this too, but like education should squash fear, right? Just like if you're concerned about something, is because you don't understand it enough. But those are the people I think that are kind of sitting on the sidelines, is the ones that don't know how to find opportunity or concerned. And I think we've hit that point home enough. But there certainly is opportunity, I think, Ben, and we're
Yeah.
being very
Yeah.
active
And
ourselves.
that's a good, I love that. We'll maybe end it there where if you're, finding yourself in a spot where you're hesitant to move forward, you're not sure what to do, continue to get educated, and learn the market, learn the strategy, and ultimately having clarity and having that knowledge is going to lead you to being confident in your decisions. So with that, how can someone that's curious about turnkey investing, hey, I want to put my money to work, I want to buy in a good market, I don't have the ability to pick up a rehab project and do that long distance or whatever, so they're like what you're hearing or what you're saying in your model, how can they get in touch with you and talk to you more, you or your team more about what you can do for them?
Great. I think the best place to go is our website. That's renttoretirement.com. It's renttoretirement.com. They can call 800-311-6781 if you're listening on audio. But essentially, our website has links to all of our social, to our podcast, our YouTube channel. We put out a ton of educational content, not just turnkey. I mean, we put out market analytics and different lending options. We didn't get a chance to talk about the new creative loan option, but we have a portfolio lender that will do up to 5 investment properties with as little as 5% down. Now you still have to qualify for those, and that is something that for the right person it makes sense. You don't have to put only 5% down. You could put 6, 7, 8, whatever makes sense. But we have many of those lending resources we'll share with you, whether you work with us or not. But yeah, just feel free to reach out. We always want to schedule an investment consultation with our team to learn about your goals and your criteria, and then help match you with the right market and investments based on your goals.
That's awesome, and I love that because I think that's one of the biggest keys to being successful in investing is um, working with someone that is actually trying to understand your goals, or maybe you don't know your goals and they help you down that path to figure that out. What do you want real estate to do for you, so that you're making the right investment decisions to actually reach your goals, and you're not looking back and saying, oh shoot, I should have done a different strategy or done something else, but I didn't really think it through. I just, hey, you know what, buying real estate and not knowing your strategy is probably better than not buying any real estate, but it's better to start with goals and a strategy in mind, and make sure you're setting yourself up on the right path for success. So I
Absolutely. I
appreciate
love
that
it.
about you guys, that your education first and consultative approach and all of that. That's super important. So Zach, thanks again for being on the show. Appreciate it. We'll make sure to have you on again just to make sure we're getting updated on what you're doing. But love what you're doing, and I appreciate you sharing.
Yeah, thanks so much for having me again, Ben. Appreciate all the education you're putting out there, and we'll check in, on the next market change or whatever happens. It's always a pleasure to chat with you.
Absolutely. All right. Sounds great. Thanks again, Zach.